We've seen some remarkable performance out of the emerging markets over the last few months. The Taiwanese index finally overcame an all-time high that was previously set in 1989, and to put that in perspective, it's the same time that the Japanese bubble peaked, a level that the Nikkei 225 has not yet repeated. The Korean Kospi market has also broken the all-time highs, though the wait from the previous record was not as long as it has been for Taiwan. But the performance of these Asian markets is as much to do with their handling of the crisis and the tech-heavy nature of their indices, especially Taiwan, as it is about the reflation theme that has become the rallying point for this current bout of risk-on. When we look at some of these Asian markets versus the broad-based emerging markets, we're using the MSCI emerging market here versus its constituents, so that we are comparing apples with apples. We can see that the performance has indeed been very regional. Korea and Taiwan have outperformed. But when we look at other regions such as Latin America, the performance is far less emphatic. There are fewer signs that this is true global growth, and more signs that this is an Asian bonanza. The ratio of the Brazilian market versus EEM looks like it's about to break down even further. The same applies to the Mexican equity market and to South Africa. If the US reflation was real, then Mexico should be one of the biggest beneficiaries, but it's struggling to generate any performance. When we compare Brazil and Mexico to the US equity market, there has been some outperformance in recent months, but they've still failed to make back the ground that they lost in the early part of the pandemic. We can also see a similar story in currency markets. The broad-based JP Morgan EMFX index, which is inverted here, has outperformed the US dollar, but the performance has been very lackluster when compared to that of the DXY, which is dominated by the euro. True global growth should see emerging market economies and currencies outperforming the lower beta developed markets. The weakness in the dollar has primarily been about positioning versus the euro and real rate differentials rather than growth. And as outlined in the prior episodes, the growth that is currently underpinning these markets is not well spread, and much of it is derived from the weaker dollar, better localized handling of the pandemic, and China, which has once again returned to the growth at any cost model that's helped create a squeeze on commodities just when supply chains have been creaking, and that's not likely to be a lasting effect. Now, we might expect Chinese policymakers to keep up the energy levels into the Communist Party's 100th anniversary in July of this year, but that will represent demand brought forward rather than a long-term growth push. The dispersion amongst emerging markets and the lack of growth in many of the former hotspots is another reason for caution. The US might be talking up the fiscal potential, but it will be hard for the US to generate inflation if much of the rest of the world is generating deflation. So in summary, global volatility levels have been lower, but many of the cross-asset levels that we looked at in the previous section are at attractive levels, considering the level of dislocation rather than convergence within the global economy.